Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. Or at Banking Day. This week's Talking Business is brought to you by multi-award-winning law firm McDonald Legal, experts in the areas of dispute resolution and commercial and property law. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from our website, leongettler.com. I'm Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 8 in our series for 2023, and today's date is Friday, March the 24th. First, I'll be talking to Ian McAdam, the CEO of Capsifi, one of Australia's leading software providers for enterprise architecture and innovation. And I'll be talking to Indeed economist Callum Pickering about the latest unemployment figures. But now let's talk to Ian McAdam. Ian, in terms of your work at Capsifi, you bring a broad range of skills. You were formerly at Salesforce and you actually helped them through a very, very difficult period. What are you going to do for Capsifi?
Okay, so the Capsifi actually has a really good opportunity to transform in the sense that to grow into a much larger company. I'll tell you a couple of reasons why is that at the middle of last year, it was very fortunate enough to have a capital injection from an Australian Business Growth Fund, and what that did is actually help set up a new strategy in order to be able to explore, the beachheads that the company had formulated in the US with customers like American Express, Merrill Lynch, etc., and customers in Europe like IKEA. What it did find is that Capsifi is actually at a stage whereby, in order to start drawing down on that capital, exploring new markets and expanding on the footprints they have, it's a great chance for growth. What has also happened in parallel is that there was a search, apart from myself, to take over the leadership of the role from Dr. Terry Roach, who was the founder and certainly set the company up beautifully with those great logos, such as I've mentioned before. But also there's a new chairman by the name of Andrew Barkler has joined at the same time as myself. Andrew, as more recently, was the Chief Executive Officer at IDP Education. Prior to that was at SAP, Unisys and PeopleSoft. And also joining me this month as well as the Chief Revenue Officer is Tony Mascarena. So we're actually now putting, I suppose, a new lens on the company with different leadership on all aspects, being a chair, CEO, sales, etc., in order to take the great work that Dr. Terry Roach has done over the last 5 to 9 years, to then take it to the next level.
And of course, Capsifi has all sorts of customers in the US, like American Express.
Correct.
And Merrill Lynch.
Merrill Lynch, exactly. And, there are a number of other big brand names that we're fortunately talking to at the moment, because, the concept of companies coming out of the post-pandemic, whereby there is a lot of siloed information that needs to be pulled together. What Capsifi is really good as a business architecture platform, it takes those disparate information, that siloed information, brings it into a common platform so that business leaders can not only make informed decisions, but they can actually talk to the same numbers that they're seeing, which they don't always do.
Is that an issue?
It is definitely an issue. And I think it's not just because we can blame the pandemic. I think it's always been an issue, in the sense that as companies grow, there is a whole lot of different silos of information, of technology, of deposits of information that don't necessarily talk to each other, and that issue is old, but it's also it's just a byproduct of growth.
Well, one of the issues with silos is that different parts of the organization don't talk to each other.
Exactly right, and this software helps to eliminate the misunderstandings and increases the communication. Once you increase that communication, not only are you actually helping employee satisfaction increase, it means that your end user, your customer, actually has a better experience as well, because they can know that you're gathering that information in a timely way and giving it to an experience that they expect.
Well, how specifically can you get these different parts of the organization talking to each other?
Well, that's the beauty of this platform, Leon, is that it is a journey mapping process, that is a way of planning out what is the art of the possible. And the beauty of the platform is that it's almost like the spaghetti that's in the background that's then been brought together to be able to say that, right, if we were to go ahead with this initiative or this market or this product, that information can be drawn from all these different sources into one place. And what it does is say that by pressing that button, thing's going to blow up. By pressing this button, this thing's going to grow by this amount of money. And that's really where the beauty of the platform is.
That takes an extraordinary amount of analysis, doesn't it?
It does, and that's the beauty of the work that Dr. Terry Roach and the team have been doing. For the last, as I mentioned, the last 5 to 9 years, is that there has been an incredible amount of work that's been done in the background, and that's why I'm personally very excited to be joining at exactly this time, because the work that's been done and the ability to be able to now start drawing down on those data sets, on those industry plans, on those industry focused solutions, it's time to really hone in and demonstrate the power of the work that's been done.
What is Capsifi doing in Australia? What are its customers? Where are its customers?
So actually, it's quite broad. It's certainly in public sector. There's a number of customers. There is customers in the financial sector. There's customers in health, in the private health sector, and more recently we're moving into services as far as cybersecurity and stuff like that. I think the opportunity for us, Leon, is to partner better with global service integrators, not just here in Australia but globally, because there is a benefit for this particular technology to not only the practices using it to improve their ability to give advice on digital transformation or transformation just generally. They will be able to improve their practice work, and then also ultimately their customers, their end users. So look, in Australia, whilst we do actually have a number of industries that we're playing with at the moment, the go-to-market is pretty much going to be pivoting towards partnering much more closely with these GSIs in order to be able to amplify the benefit that a tool that Capsifi could do within their firms and obviously their end users.
So the idea would be for Capsifi to partner with overseas platforms as well.
Absolutely, and we actually have. In fact, I'll be heading off to the UK in a couple of weeks' time to work with a GSI over there, so that with a very large name brand that we are hoping to go live within the next 2 to 3 weeks. And it is, whether we're here in Australia or overseas, the problem is the same. And that's the beauty of us having demonstrated to one partnership that it can work on this large logo. Then why don't you take that IP and replicate it? Even though a partnership is federated, it's separated out, the ability to replicate best practices is clearly front of mind.
But the trick would be to convince your clients that that's in their best interest too.
Well, sometimes the clients are, well, that's a very good point, Leon, but I also find that because we're dealing with large, complex multinationals, enterprises, they tend to already be embedded with a trusted advisor being a GSI, and the ability for the GSI to say, hey, this tool does work for these reasons, and the reason why you're going to get efficiency is these reasons is part of the value proposition that we have, Leon, and it's tapping into the pre-existing relationship that is governed on a cadence, often at board meetings, that we feel as though that the confidence that we have that this product will work for them will then translate into the confidence to the end user.
Because the key then is that your Australian clients are large.
Yes, correct. Actually, really we find that we can only play in the large complex organizations, and the reason being is in order to get the best out of the tool, which is a very complex and deep tool, is that you have to have a complex organization, a complex enterprise, which therefore defaults to just large scale. That's the way that these companies will get the best out of Capsifi.
Okay, and so they wouldn't have a problem with you partnering with overseas platforms at all?
No, not at all. And it's more about the fact that once the integrator believes in the power of what's actually going to be giving relevant, timely information, whether it's in one country or the other, it's that you already have that existing trusted relationship.
So what other innovations can you bring to Capsifi?
So look, one of the things, we've just finished a strategy session actually this week, and one of the open items and we're exploring at the moment is to move not just from enterprise architecture, but why don't we move into government risk and compliance? Why don't we actually move into specifically into the strategy here, a strategy quadrant? That there is the ability for us to take the deep information that we've had that was really specifically identified originally as being enterprise architecture, moved into business architecture, that then moves into GRC and government risk and compliance, and then other areas. So look, there is a foundation here that's very solid, It's on the back of some very intelligent men and women that have built these data sets, and I do believe that some replication and evolution of this can move into different sectors.
Well, that's quite exciting for Capsifi, I would imagine. Quite exciting. And of course, strategy and risk are huge issues.
It's something that'll probably never go away, Leon. And it's if anything that the pandemic has taught us, and even more recently with some cybersecurity issues that the world is experiencing, not just here in Australia but internationally, is that the management of the risk of what large corporations have to play with is probably not going to go away, and the identification of what is an acceptable risk to a board and even to an executive suite is the key to be able to have the right information to be able to make that judgment call. Therefore, the value of what Capsifi brings is the right to be able to make an informed decision for that risk analysis.
And the beauty of that is that it would involve so many people in your organisation.
And that's it's not just that, Leon. It is a lot of people, but it's then finally a lot of people talking the same information. A lot of people having the same information that says that this result will happen if you press this button. I use that term again. It's a lot of people, but it's then to start talking a common information set.
One last question: are you using AI?
We are just moving into AI now, Leon, and that's the other thing that we are exploring as to how much further we in our research and development team that we will move into that sphere. Clearly, it is just something that has to be embraced by us, and it'll be just part of the evolution of this great tool.
Well, Ian, it's been fantastic talking to you.
Thank you, Leon. Likewise.
Thank you, and let's keep in touch. Thank you.
Now let's talk to Indeed economist Callum Pickering. Well, Callum, unemployment has gone down from 3.7% to 3.5%. What's your view about it?
Yeah, it was a really strong outcome following a couple of weaker months throughout December and January. The unemployment rate down to 3.5%, 3.7% last month. It's one of the lowest levels that the unemployment rate's been at in the past 48 years. So it's a clear indication that the labour market is incredibly tight right now and continues to be tight despite the impact of high inflation and rising interest rates. The broader measures of unemployment or labour market conditions also improved. The underemployment rate down to 5.8%. That's the lowest level since August of 2008. And the underutilisation rate down to 9.4%. And that was the second lowest outcome in 40 years. So some pretty strong results out of the latest labour force survey.
What can explain why it was up to 3.7% last and why it's down to 3.5%?
I mean, one factor that we always need to bear in mind is that there is quite a bit of volatility in the monthly statistics. And so the unemployment rate can move quite wildly from month to month. And we need to bear that in mind when things go poorly, as they did over the past couple of months with the increase in the unemployment rate, but also when there is a big downward movement as well, which has obviously been the case in February. There were also some seasonal impacts around Christmas that could have also led to a brief increase in the unemployment rate and a fall in employment over those December and January months as well.
Do we see the prospect of unemployment rising? I mean, so the RBA has talked about unemployment going up. What's your view about that?
Well, there is certainly an expectation that the unemployment rate is going to increase in line with the expected slowdown in the Australian economy. Now, I do tend to agree with that assessment that the economy is going to slow and the unemployment rate is likely to increase. But I don't think we're going to see a sharp rise in the unemployment rate in the near term. And the main reason for that is simply that forward-looking measures of labour market demand remain really healthy. And I'm talking about job vacancies and job advertisements that are still well above pre-pandemic levels. So we're still in this labour market where if you lose your job, you can reasonably expect to find a new job pretty quickly. And it's a labour market where job seekers are still spoilt for choice. And typically that isn't consistent with a spike in the unemployment rate. So if it does increase, I think it'll be relatively gradual over the course of the year, which could push the unemployment rate above 4% by year end.
So you're saying all those factors mean it isn't consistent with a spike in the unemployment rate at all?
No, not a spike. Gradual increase, yes, I can definitely see that. But for there to be a spike in the unemployment rate, something really has to fundamentally shift. We'd need to see job vacancies fall sharply, probably below pre-pandemic levels. For that to occur, you'd need to see about a 50% decline in job vacancies, which is a pretty sizable movement. Until that happens, it doesn't seem feasible to me that the unemployment rate could increase sharply over, the course of a 6-month period. The more gradual increase, the movement from 3.5 to 3.6 to 3.7, absolutely that could happen. But a jump beyond 4% to 4.5% to 5% seems unlikely given the current dynamics in the Australian labour market.
What impact would that have on wages? Well,
Right.
The continuation of this very low unemployment rate.
Well, certainly if we remain below 4%, which I anticipate we will over at least the next 6 months, and that should continue to put a little bit of upward pressure on wage growth. It does appear as though private sector wage growth is headed for 4% or thereabouts, which we haven't seen since the global financial crisis began. Public sector wages are a little bit uncertain. They've certainly lagged the overall wage recovery thus far, with both state and federal governments pretty keen to keep a lid on wage growth due to all the spending that occurred throughout the pandemic. So we should expect stronger wages over the next 6 to 12 months. But unfortunately, that's not going to be enough to match what we've seen with inflation. And so adjusted for inflation, Australian wages are still going to go backwards over the course of this year.
What does that mean in terms of the RBA?
Well, the RBA is in a really interesting situation at the moment. Cash rate expectations have swung wildly over the past week and a half due to the collapse of the Silicon Valley Bank in the US and some concerns around some other major banks as well. Right now, the market is actually pricing in no more rate hikes. In fact, they're actually pricing in a rate cut by July, which is a rather stunning shift from the series of rate hikes that were anticipated at the beginning of the month. So the market is certainly pretty skittish. They're very concerned about what they're seeing in financial markets, what they're seeing with regards to the banking sector in the US and in Europe, and they've adjusted their expectations accordingly. Now, there is little doubt that financial stability concerns will play a larger role in the RBA's deliberations when they meet. They're going to have quite a lot to say about this, and they're going to need to balance those financial stability risks against what is quite clearly still an overheated economy with inflation that is far too high and expected to remain quite high for the foreseeable future. So it's going to be really interesting to see where they fall on that and how their communication changes when they meet.
Although we do have some issues with financial stability, we've had 3 banks going under in the US, and Credit Suisse is only going because of the Swiss government.
Yeah, that's right. And that is obviously very concerning. We know how risky that can be from our experience going through the global financial crisis and how quickly a problem in one bank can spill over into problems across multiple banks. I think what is different this time compared to back then is simply that government authorities and central banks are much better at managing and responding to these risks than they were during the global financial crisis. Back then, governments and central banks were sort of making things up as they went along, trying to work out what works and what doesn't. Now we sort of have a blueprint for how to respond to that. And you could sort of see that with a very swift response to the Silicon Valley Bank collapse just recently.
Now, so the big issue is about the fight against inflation. That's still becoming quite a big issue, and inflation's at that high does not come down that easily.
No, that's right. The big economic risk here is that high inflation becomes entrenched in expectations. It becomes what businesses expect, it becomes what households expect, it becomes what unions expect. And if that's the case, it becomes much more difficult to bring it down. So the RBA would be very concerned about letting high inflation run. And so I think right now, while there is those concerns around financial stability, and the RBA will obviously have an eye on that, the fight against inflation should remain the priority. Because high inflation, even over a relatively short period of time, can be incredibly damaging. You think about wage growth right now. Inflation-adjusted wages are currently at their lowest level in 11 years. And so even just a 12 to 18-month period of high inflation, which is all we've experienced, has been enough to unwind more than a decade worth of pretty hard-won wage gains. We can't afford another year like that. And I think that's probably going to drive RBA thinking in the near term, that concern around inflation, that need to bring it down to protect the household sector and to protect the overall economy.
What does that mean in terms of the number of rate hikes? Are we anticipating 2 more rate hikes?
This is a great question. As I said before around market expectations, they don't expect any more rate hikes. The market thinks the next movement is cut, and possibly as early as July. Economists are more mixed in their opinions. There's certainly economists that think that maybe 3 or 4 more rate hikes could be on offer. I tend to lean towards more 1 or 2, with the RBA perhaps being done by mid-year. The economy is still running pretty hot. It's proving to be highly resilient. So I think there is still a big risk associated with this high inflation environment. I do think around mid-year, the RBA is going to pause hikes, at least for a period. I think they want to get a good sense of the impact that existing hikes are having on the economy. And I think that over that pause, there is a good chance that the flow of economic data will shift sufficiently to make that pause more permanent. Now, given some of the financial stability concerns right now, the RBA might decide to pause now. They might decide that the risks are too great to continue hiking, and they'll simply pause and assess what they've done now, in which case, you probably wouldn't expect to see a rate hike either again, or at least not until the second half of the year. So I think, as is quite clear, there's a lot of uncertainty surrounding RBA policy right now, and it's shifted quite significantly in just a week or two.
Well, Callum, we'll be watching this quite closely, and thank you again for your time.
Thank you, Leon.
Need legal information or legal advice? Today's podcast is brought to you by multi-award-winning law firm McDonald Legal, experts in the areas of dispute resolution and commercial and property law. For a free consultation on your legal matter, McDonald Legal can be reached on 03 9070 1107 or by visiting the website www.mcdonaldlegal.com.au. So what's happening in the news? Well, UBS has agreed to buy Credit Suisse in an historic government-brokered deal aimed at containing a crisis of confidence that had started to spread across global financial markets. The Swiss bank is paying more than US $2 billion for its rival. It will be an all-share deal and priced at a fraction of Credit Suisse's close on Friday, when the bank was valued at 7.4 billion francs, or US $8 billion. The Swiss National Bank is offering a US $100 billion liquidity line to UBS, while the government is granting a 9 billion franc guarantee to assume potential losses from assets UBS is taking over. The plan, negotiated in hastily arranged crisis talks over the weekend, seeks to address a massive rout in Credit Suisse's stock and bonds over the past week, following the collapse of smaller US lenders. A liquidity backstop by the Swiss Central Bank midweek failed to end a market drama that threatened to send clients or counterparties fleeing, with potential ramifications for the broader industry. US authorities have been working with their Swiss counterparts because both lenders have operations in the US and are considered systematically important in Switzerland, Bloomberg reported earlier. Authorities sought an agreement before markets opened again in Asia. UBS had earlier tabled an offer of about 1 billion francs, or 0.2 francs a share for Credit Suisse, which the firm had pushed back on. The takeover of the 166-year-old lender marks an historic event for the nation and global finance. The former Schweizerische Kreditanstalt was founded by industrialist Alfred Escher in 1856 to finance a build-out of the mountainous nation's railway network. It had grown into a global powerhouse, symbolising Switzerland's role as a global financial centre before struggling to adapt to a changing banking landscape after the financial crisis. UBS traces its roots back through some 370 separate institutions over 160 years, culminating in the merger of the Union Bank of Switzerland and the Swiss Bank Corporation in 1998. After emerging from a state bailout during the 2008 financial crisis, UBS built a reputation as one of the world's largest wealth managers, catering to high and ultra-high net worth individuals globally. While Credit Suisse avoided a bailout during the financial crisis, it has been hammered over recent years by a series of blow-ups, scandals, leadership changes and legal issues. Clients had pulled more than $100 billion of assets in the last 3 months of last year as concerns mounted about its financial health, and the outflows continued even after it tapped shareholders in a 4 billion franc capital raising. And banking and financial stocks fell in Australia, London and across Europe on Monday after the emergency rescue of Credit Suisse by rival Swiss bank UBS failed to calm markets. In Australia, financials AXFJ fell about 1.8%, with all the big four banks ending in the red. In the UK, NatWest, Barclays and Standard Chartered were all down more than 7%, while HSBC and Lloyds also fell about 5% in early trading before recovering some ground. European banking shares, as measured by the Stoxx Europe 600 Banks Index, was down nearly 3% on Monday morning. Credit Suisse shares plunged 60%, while UBS was down 7%. The fresh jitters were partly prompted by the terms of the rescue deal, which saw holders of $17 billion of Credit Suisse's bonds wiped out, while equity investors were not as badly affected. And Amazon plans to eliminate 9,000 more jobs in the next few weeks, CEO Andy Jassy said in a memo to staff on Monday. The job cuts would mark the second largest round of layoffs in the company's history, adding to the 18,000 employees the tech giant said it would lay off in January, taking the total number of job losses at Amazon so far to 27,000. The company's workforce doubled during the pandemic, however, in the midst of a hiring surge across almost the entire tech sector. Tech companies have announced tens of thousands of job cuts this year. In the memo, Jassy said the second phase of the company's annual planning process, completed this month, led to the additional job cuts. He said Amazon will still hire in some strategic areas. The job cuts announced Monday will hit profitable areas for the company, including its cloud computing unit, AWS, and its burgeoning advertising business. Twitch, the gaming platform Amazon owns, will also see some layoffs, as well as Amazon's PXD organisations, which handle human resources and other functions. Prior layoffs had also hit PXT, the company's store division, which encompasses its e-commerce business, as well as the company's bricks and mortar stores such as Amazon Fresh and Amazon Go, and other departments such as the one that runs virtual assistant Alexa. And Foxconn chairman Rupert Murdoch is engaged to former San Francisco police chaplain Anne Leslie Smith, his spokesman has confirmed, which will mark the fifth marriage for the 92-year-old media mogul. Murdoch finalised his divorce from actress and model Jerry Hall in August. Murdoch and Smith, 66, first met in September at his vineyard in Moraga in Bel Air, California, and he called her 2 weeks later, Murdoch told News Corp-owned New York Post, which broke the news of the engagement. Smith is a widow whose late husband was Chester Smith, a country singer, radio and TV executive. On March 17 in New York, Murdoch presented Smith with an Asher-cut diamond solitaire ring, according to the Post. They'll be married in the Northern Hemisphere summer. I was very nervous. I dreaded falling in love, but I knew this would be my last. Better be. I'm happy, Murdoch told the Post. Murdoch's nuptials are likely to change the ownership structure of businesses in which she holds stakes, including Foxcorp, the parent company of Fox News Channel, and News Corp. Murdoch controls News Corp and Foxcorp through a Reno, Nevada-based family trust that holds roughly a 40% stake in voting shares of each company. Fox is currently defending itself in a US $1.6 billion, that's Aussie $2.4 billion, defamation lawsuit from Dominion Voting Systems. Dominion has accused the cable TV network of amplifying claims that Dominion voting machines were used to rig the election against Republican Donald Trump and in favour of his rival Joe Biden, who won the election. Fox has defended its coverage, arguing claims by Trump and his lawyers were inherently newsworthy and protected by the First Amendment of the US Constitution. And avoiding the worst ravages of climate breakdown is still possible, and there are multiple feasible and effective options for doing this, the Intergovernmental Panel on Climate Change have said. Ho-Sang Lee, chairman of the body, which is made of the world's leading climate scientists, made clear that despite the widespread damage already being caused by extreme weather and the looming threat of potential catastrophic changes, the future was still humanity's to shape. This positive framing of a report that makes very grim reading was a deliberate counterblast to the many voices that have said the world has little chance of limiting global heating to 1.5 degrees Celsius above pre-industrial levels, the threshold beyond which many of the impacts of the crisis will rapidly become irreversible. Finance would be key. The shift to a low-carbon economy would take between 3 and 6 times the amounts of funding currently devoted to green investment, according to the final section of the IPCC's comprehensive 6th Assessment Report, or the AR6, of human knowledge of the climate. IPCC scientists and climate experts emphasise that this decade would be crucial, as decisions made now would affect the future of the planet for hundreds and perhaps thousands of years. And the nation's prudential regulator has begun asking banks to declare their exposures, in some cases daily, to startups and crypto-focused ventures following the collapse of Silicon Valley Bank and volatility at global lenders. The Australian Prudential Regulation Authority has told banks to improve their reporting around crypto assets and provide daily updates to the agency as it sought to gain more insight into exposures and vulnerabilities in the system. The increased supervision comes after startups pulled funds deposited with SVB, triggering its collapse, and after Credit Suisse suffered outflows from its customers concerned about its profitability as it attempted a complicated and lengthy restructuring process. And Australian mortgage holders might finally be in for a reprieve on interest rates, with the Reserve Bank indicating it will consider a pause in hike at its next meeting. Minutes from the bank's March meeting, released on Tuesday, show the RBA board members acknowledged that the economic outlook was uncertain and monetary policy was now restrictive. Members agreed to reconsider the case for a pause at the following meeting, recognising that pausing would allow additional time to reassess the outlook for the economy, the minutes from the March 7 meeting said. The considerations meant it would be appropriate at some point to hold the cash rate steady to assess more fully the effect of interest rate increases to date. An environmental lobby group, Market Forces, has accused 5 super funds and their leadership censorship of greenwashing and failing to use their voting power to push big emitters to clean up their act. In a report published on Wednesday, market forces accused Aware Super, Australian Super, AMP, Australian Retirement Trust and Commonwealth Supercorp of greenwashing. Market forces allege that the 5 funds overstate their green credentials to retirement savers, claiming they support net zero goals but fail to exercise their voting muscle to force dirty companies to clean up their operations. These funds are alleged to be relying on influencing fossil fuel companies, including Santos and Woodside, by engaging with management to meet climate targets. But market forces said the funds have failed to adopt or implement effective active ownership practices across 5 criteria. The environmental lobby group, which has previously targeted several retirement savings giants, claims these funds are legally required to have reasonable grounds to believe they will achieve their goals. And non-bank lender Latitude says a sophisticated, well-organised and malicious cyber attack remains active inside its systems and is not taking on any new customers after being forced to isolate some of its technology platforms. Latitude also revealed on Monday that more customers, including past customers and applicants for credit, could fall victim to the attack after it said last week about 330,000 customers had their personal identification stolen. The non-bank lender confirmed that Medicare numbers and copies of passports or passport numbers were included in the theft of personal information, affecting approximately 330,000 customers and applicants. In an update to the ASX, the lender said it was continuing our forensic review of our IT platforms to identify the full extent of the theft of customer information as a result of the attack on Latitude. The stock remains in a voluntary suspension and is not traded since Wednesday after the attack on 3 of its software vendors was announced before the market opened last Thursday. The shares will remain suspended for another few days, pending any earlier announcement. The incident is being investigated by the Australian Federal Police. The update comes as a major cybersecurity conference gets underway in Canberra and follows major cyber breaches at Optus and Medibank last year. Latitude has not said whether the attack has included any demands for ransom to be paid to prevent customer information being posted onto the dark web. The source of the attack also remains unclear. And the Big Four banks' exposure to the Australian resources industry has sunk to a decade low, and lending veterans say an erosion of technical nous and risk appetite means that local banks will struggle to capitalise on the next boom in future-facing commodities. Data compiled by Bridgend Capital Advisory shows the Big Four Australian banks' combined exposure to mining, oil and gas clients had declined by almost $25 billion since peaking at $64.7 billion in 2015. The decline has been particularly sharp at Commonwealth Bank, where the nation's biggest export industry ranks as just the 15th biggest lending market, and the total committed exposure to resources has slumped from almost $17 billion to barely $7 billion between 2015 and 2022. The resources sector has slumped from 1.9% of the Commonwealth Bank's total loan book to 0.6% over the same period. NAB has been the most resilient, with resources exposure declining from 1.2% of its book to 0.9% over the same period. The decline has been driven by a combination of cyclical and structural factors. An era of high commodity prices has filled miners like BHP and Rio Tinto with cash and reduced their need for loans, while banks have also deliberately reduced their exposure to fossil fuel producers. But the Big Four banks have also missed the boom in future-facing or critical minerals like lithium, graphite, hydrogen and rare earths over the past 8 years, because the opaque and immature nature of those industries meant local banks were not confident managing risks through futures markets and hedging as they do for traditional commodities. Australia's critical minerals producers have instead been funded by end consumers, shareholder equity, offshore banks and government lending agencies like Export Finance Australia, the US Department of Defence and Japan's Innovation Fund. And Victoria's wage theft laws are facing a constitutional challenge that would neutralise states' powers to bring criminal charges over underpayments if successful. Regional restaurant Macedon Lounge, the first business to be charged with wage theft offences, has applied to the High Court in a bid to argue the Victorian laws are invalid because they clash with federal laws governing underpayments. The challenge will have ramifications for other Labor government state wage theft laws, including Queensland and South Australia, as well as the Albanese government's upcoming criminal laws for underpayments. Victoria's wage theft offences took effect in July 2021, and the Andrews government set aside $17.5 million to fund a new agency, the Wage Inspectorate Victoria, to enforce the laws. However, the government was criticised at the time by the Coalition and experts for wasting millions of dollars on laws that would be made redundant by upcoming federal laws or otherwise rendered unconstitutional. The Victorian Wage Inspectorate proceeded to hit the Macedon Lounge and owner Gaurav Setia with 94 criminal charges in November for allegedly underpaying 4 employers a total of $7,265 over a 5-month period. The Inspectorate took 17 witness statements over the allegations and produced 275 pieces of documentary evidence, according to court documents. Mrs. Setia, if convicted, faces up to $218,000 in fines or as much as 10 years in prison, and the restaurant could be fined more than $1 million. Barrister Lee Howard for Mrs. Setia and Macedon Lounge flagged Broadmeadows Magistrate Court last week that the parties had launched a constitutional challenge to the case. According to documents filed in the High Court by Mr. Howard and Barrister Justin Burke KC, the wage theft laws and the Inspectorate's powers to investigate them are invalid according to Section 19 of the Constitution. That section says when a state law is inconsistent with a Commonwealth law, the latter should prevail. And the time it takes for a couple to save a 20% deposit to buy an entry-level house has shrunk by 8 months nationwide since interest rates started rising in last May, as falling prices reduce the amount they need to stash away, and improving wages and higher interest rates on savings bolstered their finances, a new report from Domain shows. But the portion of income needed to service their mortgage has blown out to 41%, a new record, sparked by the 10 consecutive rate hikes. Meanwhile, a separate study from the Australian Housing and Urban Research Institute, AHURI, found that it was virtually impossible for any 25 to 34-year-olds to save enough deposit on their own amid higher property prices and surging costs of living. Domain's analysis found that a couple buying their first home would now need 6 years and 8 months to save a deposit on an average entry-level house around the country after sharp falls in home prices slash the amount they have to accumulate. Since interest rates started rising, home values have dropped by 9.1%, or the equivalent of a $69,983 discount nationwide, according to CoreLogic. Despite the marked reduction in the time it takes to save a deposit, the amount of mortgage a Sydney couple need to service a mortgage has ballooned to a new high of 51% of their income, a large jump from 31.5% recorded during the recent boom. In Melbourne, the share of mortgage repayments rose to 42.1%, up from 29% in 2021. The portion of mortgage repayments expanded to 29.8% in Brisbane, 35% in Adelaide, and 45.3% in Canberra. First home buyers in Hobart now need to spend 42.1% of their income to repay their mortgage, 26.2% in Perth, and 25.6% in Darwin. And that's it for this week. And next week I'll be talking to founder of Renovatio, one of the country's fastest growing health and wellness brands. Dr. Vincent is a food scientist and clinical nutritionist, researcher and health and wellness expert. And I'll be talking to Rabobank economist Michael Every about how the Chinese economy is going with the reopening. This show is brought to you by multi-award-winning law firm McDonald Legal, experts in the areas of dispute resolution, commercial and property law. For a free consultation on your legal matter, McDonald Legal can be reached on 03 9070 1107 or by visiting the website www.mcdonaldlegal.com.au. In the meantime, you can catch me on Facebook, Twitter, Instagram, LinkedIn and YouTube. And if you want, leave a comment. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business on the Apple Podcast Store or on my website leongettler.com. Wishing you all a safe